Hello, welcome to RHB Money Chat. Today we have Dr. Sailesh, RHB Group Chief Economist and Head of Market Research. Thank you very much, Dr. Jha, for attending our Money Chat series. Before we start, maybe we can have a quick check on the asset allocation view. Earlier of the year, you have started the year to overweight in equity, neutral in fixed income, and underweight in cash. However, due to the material change in the market condition, market has also priced in potential 7 times of rate hike. And to make things worse, with the current Russia-Ukraine war that we are seeing now, has that changed your asset allocation view? Can you share your thoughts on this?
Sure. I just want to reiterate that's the entire year's asset allocation for 2022, and this view was put forth in our global market and economic outlook in December of 2021. There's no change to our overall asset allocation view, where we're firmly in the camp of being overweight equities and alternative assets, market weight fixed income, and underweight cash. One of the primary reasons, we'll get to that later when you ask me more question, is that we have always been of the view that essentially the Fed will be hiking much less than what the market will be pricing in as we traverse the course of 2022, and thus global liquidity conditions will remain ample. Second, that essentially, we will get periods of volatility and weakness in market sentiment, but we would like to pass through those event risks. And third, that the overall outlook for growth and inflation looks pretty decent for the entire 2022. Having said that, with these risks, as you mentioned, with the geopolitical risk upon us in Ukraine, and that it has turned out that even by all our calculation, by any measure, the market has gone ballistic in terms of its, and I don't use that word loosely, in terms of rate hike expectation of 7 hikes this year. Early part of the year, the market was expecting 3 hikes, and we're back down to now about 5 hikes priced by markets today. And that's exactly what we thought would happen, that basically markets would start repricing down to our view. Tactically, we are looking to buy that dip in risky assets, but we have been saying all along for the better part of first quarter, even before the war in Ukraine started, that it's not time to buy yet. We were looking at second quarter, and that view still hasn't changed, despite these geopolitical risks arising unexpectedly.
Yeah, right. So, Dr. Jha, you have mentioned quite a few times, to reiterate again the RHB house view, that the potential interest rate hike for RHB house view is only 3 times. So if that really happened and market has really mispriced it for now, so does it mean that the lower rate hike will have a significant impact to the recovery in the equity market moving forward? Is that one of the key catalysts?
That is absolutely one of the key catalysts, Nova, because what that means is that the liquidity conditions, as it applies to the U.S. and the rest of the world, where the U.S. market is the major provider of liquidity globally, right? Because we're in a dollarized world, isn't it? Means the global liquidity remains fairly ample, and that should be pretty bullish for a global equity market. And there are nuances by geography, so we can get to that later when we discuss the nuances with geographies. Do we like? Of course, the risk right now is that the situation in Ukraine is fluid, right? And so if the risk of, and it's a significant risk, is that we're in all out military conflict across Europe, not just confined to Ukraine, then basically very different asset allocation will be much more cautious on risky assets such as equities. We're not there yet. We don't see that happening, and we can go through the details of why currently we don't see that all out Europe-wide military conflict arising. But as the old saying goes in America, never say never, right? So that's where we are.
Okay, thank you. Dr. Jia, maybe just track a bit, especially for Malaysian investor, as I'm sure there's a lot of question about ringgit. So if the interest rate hike in US is like, let's say market price 6 to 7 times, while if it really happen 3 times, while for Malaysia expectation for interest rate hike maybe it's only 1 time. So there is a huge discrepancy between the interest rate movement between US and Malaysia. So would that have a material impact to the weakening of ringgit against US dollar?
It's a short-term event risk. So our view all along has been, and keeping in mind that the our view from my team has been a bullish dollar since December 2020, since I joined the firm, right? And coming into this year, we've been looking to essentially sell dollars against Asian currencies, including Malaysian ringgit, sometime in the second quarter. So the bottom line is our end of first quarter view remains intact of 430 and a nice glide path down to 415 by the end of 2022. What we're thinking is that the interest rate differential channel, which you mentioned, which affects currencies, will have been fully priced in by markets as we exit the first quarter. Pretty much as we're exiting the first hike, 25 basis point hike in on March 17 FOMC, and in the second quarter we should start seeing that interest rate differential spread is fully priced, and what takes over is that the flows, which look pretty good to Malaysia right now. We all know essentially that the flows to equity market are pretty decent right now. Bond market really not showing any signs of flows, weaknesses in flows in terms of net capitals, despite net outflows from emerging markets. And the third is that as the recovery gathers, further steam, first quarter is a soft patch in Malaysia for us in terms of growth, but as we approach from summer onward, second half, the trajectory of growth should be much firmer. And the U.S. will be slowing anyway, right? So the growth differential spread starts becoming less favorable for dollar and more favorable towards Malaysia. So those are the three factors where ultimately the ringgit appreciates against dollar to 415 by the year end, with one last hurrah for the dollar, I like to call it, to 430 by the end of this quarter.
Yeah, right. So let's address the elephant in the room, which is the Russian invasion to Ukraine. So on the 24th and 25th February itself, U.S. equity market represented by S&P 500 was up by 4% in 2 days combined. So a lot of investors will say that, wow, isn't this an opportunity to buy already? Are we past the worst of this crisis? And is it really a time that investors want to buy at deep? So I would personally think that the answer could be no. It's too early to say. So, but I think the audience really wants to hear from yourself, Dr. Jha.
So our base case view is, in conclusion, that it's not time to buy that dip yet, at least in global equity markets, including the U.S. Right? We have, the risks related to Ukraine are likely to linger for much of this next couple of months, I would say. And then the risks related to the Fed aren't completely, we're not out of the woods, because the next FOMC meeting is on March 17. In the near term, what we are approaching is a stalemate situation in Ukraine in terms of the war, because we've had several developments since we wrote some of our detailed reports on Friday over the weekend. One of the things that we've been watching for is whether the NATO response force, which is a show of strength from the Western allies, is actually deployed, and whether the important port of Mariupol in the Black Sea, which is a major shipment venue for Ukraine grains and bulk shipments, whether that will be taken over by the Russians or not. The first has materialized. And let me explain what that NATO response force is to the general viewership and yourselves as well. NATO response force is a high alert force with land, air, sea, and special forces units targeted to be deployed quickly and to come to the defense of the Baltic states. So that means in plain English is NATO's there at the borders to defend, okay, and to essentially give a show of sign of strength to the Russians. You're in Ukraine, you're doing whatever you're doing, please stop there. Now, whether the Russians will stop at that is an open question. because another development, important development over the last 1 to 2 days has been negotiations between Russia and Ukraine, albeit at a low level. It's not like president to president and ministerial to ministerial level, at the Belarus border, where Belarus is a strong ally of the Russian government. All right, nothing has come forth on that, but at least there's some sort of level of diplomacy going on to stall the situation, at least from going from all-out war in Ukraine to all of a sudden the Russians encroaching on further Western territories of Western Europe. So that's a good development. Let's see what happens. And it seems like the biggest risk that we have to contend with is whether it will be an all-out war in Europe. That's why you notice that the U.S. has become the safe haven in equity markets, right? In high frequency trading, right? So far, the U.S. on the record, year to date, is the worst performing equity market in major markets across the world. For the record, right? Europe is following suit right now. So the trade right now has been, to exit European equity markets and enter U.S. Equity markets. So the buy on the dip for our purposes, we're looking to go for that buy in the dip in global equities in the second quarter, and do specifics of which geographies. We like the United States, we like India, we like parts of Southeast Asia. Within Southeast Asia, we like Malaysia, Thailand, Indonesia, less so Singapore, which is more correlated with the Chinese stock market, which we really we don't like. Yeah.
Right. Thank you very much. That's a long answer for a short question. That also means that there are multi-factor that we need to look at. So it's not so simple just to see 2 days of a market recovery, then that's the end of the crisis. I guess that is something that we really, really need to watch out for and follow up closely about the progress of the Russian and Ukraine war. Yeah. So Russia being one of the major so-called exporters for energy, oil and gas, so including the current sanction on Russia, one of the biggest commodity impact is to the oil price. So currently oil price is trading at sub $100 per barrel. With limited supply of oil to the market and increase in the oil price, US is able to sell their reserve and get more revenue. While on the other hand, China is speculated that China is potentially able to buy oil from Russia at a discounted price. So correct me if I'm wrong, that it seems like US and China are not so materially impacted by higher oil price. To make things worse, Germany has held the Nord Stream 2 approval over Russian recognition of the self-proclaimed republics in East Ukraine. So the question is, do you think that the oil price will continue its upside trajectory to hit the price that is materially above $100 per barrel in the near future?
That's a fantastic question, Nova. So let me just discuss the details of the sanctions. Okay. The and specific to SWIFT. Okay, because a SWIFT system is how you make the payments, right? Send the notification that the buy and sell orders, right, across the world from bank to bank. Correct. The SWIFT sanctions, meaning 50% of the banks by assets in Russia are now sanctioned via. They're not allowed to use SWIFT. Okay. However, the exception is on a sector basis, energy sector. That's the first thing to recognize. Right. You may so the trans from a transactional perspective, you could potentially, because the details aren't fully out yet, that how exactly does it work? You're sanctioning Russia, broadly speaking, 50% of the banks are sanctioned via using SWIFT, but you've exempted the energy sector companies. How will that work in practice? Point number one. The second aspect of it is that one of the important developments also over the weekend, right, is that at the UN Security Council, India and China abstained from making statements related to the Russian invasion of Ukraine. They're sitting on the sidelines, as we say in America, right? Not the money sitting in the sidelines, but India and in Asia, that's who matters. You know what I mean? These are the countries that matter. They're the biggest countries in Asia, outside of Japan, obviously. Japan does matter. Those are the only three countries that matter in Asia, as far as I'm concerned. No disrespect for Malaysia and other countries. The implication is that whether it's trade sanctions whether it's sanctions related to energy, whether it's sanctions related to SWIFT, the balance of risks is that basically those are transacted through China and Russia. And China and Russia are both very, remember, the Chinese banks are in the top five by assets in the world now. Okay, India is no nothing to snicker about in terms of also big banks, right? The State Bank of India is one of the biggest banks in the world. So what that means is not blowing the trumpet for China or India or being pro China or India, but the bottom line is that some of these sanctions and inhibitions or retardants to the flow of energy, flow of trade can be, or flow of transactions, sorry, financial transactions can be routed through China and India. And Nova, you're right that the Chinese can build up their reserves, which they love doing. Right, every time oil price is low, they like to buy oil, right, which has been one of the bigger supports in terms of oil prices on the downside. How will the trajectory of oil, and you haven't mentioned food, very important, right? Because those are the two biggest inflationary drivers of inflationary globally, right? First on oil, we have to look back in history that between 2015, 2017, rough period, around 2 to 3 years, around that period of time, oil was at Brent oil was $120 per barrel, average, huh? Not one day's trading. Yet global growth was pretty strong. The only difference, the difference between then and now, is that inflation was not an issue at that point of time. It was fairly well contained. It was moving up, but well contained, as opposed to today, excuse me, of inflation expectations being fairly strong. I, I think that the balance of risks is that, yes, I don't dispute the idea that oil, Brent oil, trades above $100 for a significant period of time. But as long as we basically are, below the 100, don't traverse the $100 to $120 per barrel average for the year, which I don't think we will, because we're already in the second month, 2 months 2 months is out of the way in 2022. We don't break that average of $100 to $120 per barrel. It's not going to have a profound impact, I think, on global growth. It will, of course, have an impact on inflation. But what that does with that level high oil prices, it also has a feedback loop to ultimately weakening corporate and consumer spending, right? So there'll be that demand side shock that happens. Not a tragedy, but that will create essentially a slowdown of growth in the second half of the year, which is a good thing, because then inflation starts coming off in the second half. The Fed and other major central banks don't need to hike as much as what the markets are pricing. So that would be my short answer, Nova, if that's a short answer.
Yeah, to ban the Russian from the SWIFT system. So,
Uh-huh.
what is the repercussion to the rest of the developed country? Example, like in Europe.
Right. So the impact right now is contained, in the sense that, again, keeping in mind that it doesn't ban energy sector transactions from SWIFT. What it does is impact banks with large lending and credit facilities to Russia, right? And those banks are essentially, the Eastern European banks and some Western European banks, right? The most heavily exposed are obviously the Eastern European banks. Western Europeans less so. So the impact on, European economy per se should be limited. Right now, the European stock market is reacting to the risk that we have an all-scale war in Europe. That's why you notice the European equity markets overnight selling off quite a bit.
So US has imposed a sanction to Russia, as you have mentioned just now, and they also provide some military aid to Ukraine. Do you foresee more escalation that will bring us closer to a risk of a full-blown war, with potentially more intervention from Western allies or potentially even NATO? So would Russia eventually occupy the entire Ukraine?
So here's where we are as far as NATO goes. It's already happened as far as NATO goes, right? As I mentioned earlier, the NATO response force is now being deployed to the contours of Ukraine. All the countries that are bordering Ukraine, the NATO response force is there. That is the primary. It hasn't been invoked for, I think it's the first time it's ever been invoked, actually, right, in modern history. And when I say modern history, is within my lifetime, right? Beyond that, I can't remember, right? Too far me for me to remember before I was born. Yeah. As far as a all scale war in Europe goes, full out war, it's really too early to tell. But I think the balance of risks is how we're going to. How where we're headed over the next couple of months into the second quarter of the year. It's already March 1 today. Into the second quarter of the year, we have basically a prolonged war in Ukraine and Russia. The Ukrainians, from what we see in media reports, this is not my personal opinion, is seem to be holding the line in the sand so far, right? So in a way, that's a good thing. And combining that with the NATO response force being deployed, right, has been a positive sort of development, both of them, to essentially at least stop Russia in its tracks right now in Ukraine. Whether we'll go beyond Ukraine is still an open question. I think the balance of risk is not in the next couple of months. Let's see how things evolve as we head into the second half of the year.
Okay, Ken, thanks. So, I have this question. We have been focusing quite a lot of our discussion on US. So, I always have this question about investors who have quite some big exposure in Chinese equity. So, as one says, an enemy's enemy is your friend. Since year 2016, the trade between China and Russia has gone from 50 billion to over 147 billion. And China is in fact now Russia's largest trading partner. I noticed that the market has been discussing that Beijing is certainly gain more room to maneuver and more geopolitical benefit if the conflict over Ukraine persists. My question is, do you think China actually benefits as the US attempt to contain China will take a back seat from this current situation now?
I mean, it's certainly going to remove China from the top priority of U.S. Government and the politicians, right? But it doesn't mean that all the essentially restrictions related to tech firms listing or U.S. exposure to importing technology-oriented, defense-oriented goods from China, that's going to stop. It's not, right? It in fact creates an additional level of complication for China itself because of its exposure to Russia and basically sidetracking, in a way, the Western allies and not giving them support. What it does is implicitly create negative investor sentiment from the European and U.S. investors, keeping in mind that the biggest investors in Asia, including China, are the US and European investors, right? So they will think twice, if you ask me, of, should we, in this climate of remember, we're also, geopolitics also affects investment decisions, right? We cannot be naive to think that when people invest, whoever they may be, that they don't have this personal agenda in their mind or personal feeling when they buy or sell assets. So, keeping that in mind, the flow of US and European capital into China is very important, and that's not going to happen, right? In my opinion, the risk are that flow, we're not going to get it. And so, our core view, since I joined the firm, from my first report written in December 2020, really shortly after that, actually, to be honest, has been to be fairly negative on China, right? And that view has been reiterated even in our December report. So our core view of reducing exposure to the Chinese equity market and, in fact, even the bond market, because of the recent risks that have arisen related to property and other credit risks, and shift those funds to Indian stock and equity market remains intact. No change in view whatsoever. It gets even more solidified as we go traverse through this difficult period in Ukraine. Just one last point, if I may. our view of being relatively more positive on Southeast Asia relative to North Asian equities is panning out quite nicely, right? Year to date, in dollar terms, Southeast Asia is clearly outperforming North Asia, right? Defensive. Right now, good posture. I think for a better part of this year to be defensive in nature. And in fact, quite oddly, the US gets included in that defensive posturing in global equity market.
Okay. I guess this question all the time. While now is in fact the best time to ask, that is on gold. In the recent month, gold price has briefly touched 2,000 US dollar per ounce, despite it actually came down to about sub 1,009. I know it's a very short time frame to be used as a reference point. However, what is your view on gold during this time of Russia-Ukraine war? And beside gold, is there any other alternative asset that can also be used as a hedging asset?
Yeah, I mean, gold's a difficult one, right? It's finally broken out to these levels to 2000, right? $2,000 per ounce. The challenge has been that crypto, Bitcoin, has also done pretty good recovery, right? If I look at my Bloomberg, so I'll work this through with you, right? Where are we trading today? If I may, we're at 43,518 and 517 and change, right? A swift recovery. And so it's very difficult to make a case that gold sustainably stays above 2000. It's a tough one. In fact, in our global asset allocation, one of our overweights, besides equities, is alternative assets, and and within alternative assets, alternative currencies. And so that has meant that things like Bitcoin are what we would have in our portfolio on an overweight basis rather than, let's say, gold. Because as gold has taken too long a time, from my personal perspective, of breaching 2000. It's been stuck forever. It's trading 1500, 1800 for the last couple of years. And Bitcoin has taken probably some of the luster off of gold, in my opinion.
Okay. This is my personal question. Most of the view that I have heard from other fund managers, CIO, or any other specialists, there are numerous times that they mention that we shall see stability in the second quarter of this year, or even to the extent of a second half of year 2020. So, from a very layman investor perspective, if that is the case, does it mean that investors should dump all the risky assets like equity now and wait to re-enter again either in the second quarter of this year or the second half of year 2020, 2022?
So again, the question has to be answered whether you're talking about from a tactical perspective or an investment perspective. They're two different things. So if you're a very short-term investor, day trader type, right? And I'm using the term loosely. You're trading for a day, you're trading for a week, a month, whatever, right? Very short term. If we are continuing to worry that risky assets are still looking very uncertain in terms of the outlook, you would be selling. That's true, right? But if you're more longer term investor, and we've been saying this for the longest time, and we took a lot of pain and heat on this with investors, to be honest with you, Nova, is since summer of last year, we've been advocating that increase your cash allocation precisely because of the elevated asset prices in risky asset prices from the early part of 2021 and over the last couple of years, right? So, I'm not saying that we were right or anything. It's not the point. If you had to sell as a more longer term investor, the time would have been sometime in the fourth quarter of the year, right? That would have been the time. So you entered the year, you maybe lost the last 5-10% of the rally. We never can make it, right? Getting that last benefit of the last 5 to 10%. But you would have been essentially protected from the downside that you incurred or the losses you occurred in the you wouldn't, depending on when you entered, I shouldn't say losses, but the weaknesses that you saw in markets in January, which is very rock. So the conclusion is, if you are a trader then essentially the balance of risk is you are looking to some of the rallies you're seeing over the last 2 days, depending on the geography. You are looking to lighten those positions or sell into these rallies. But if you're a longer term investor, you're looking for that buy in the dip. And for us, it's always been second quarter sometime. Even in January, when at the worst of the market sell off, we had guided investors that second quarter is probably where we're looking to buy, right? This is not a recent view. And we had given the triggers of what are the three things that we would like to see before we bought into risk. And now there's a fourth thing that we like to look at. The four things are: first, on the most recent risk that has arisen, geopolitical risk, that a long drawn affair in Ukraine. Unfortunately for our friends in Ukraine, it's more longer duration. Okay, if it's longer duration, no full scale war. Okay, fine. One of the factors to rule out further slide in risky asset prices, rule it out. The VIX index, I'd like to see it for some period at 40%. Where are we, Nova, today at VIX? Okay, thanks to RHB, I have got my Bloomberg here. We are currently trading, right? Overnight, we were at around 30, right? We have traded as high as 30 to 35% VIX. So we're getting there. So I want to see it like at 40% VIX. I'd also like to see in terms of some of the emerging market high beta currencies such as dollar Korea, dollar Indonesia, dollar IDR to some extent, the implied volatility, you say vols in simple, picks up to much higher levels too, around 10 to 15% from current level, 5 to 10%. And credit spreads in the US markets widen some more, I would say. These are the four things we're looking for. It's not an exact science, but broadly speaking, I like to see these four things materialize. Then we have the signal to essentially, and the Fed, of course, comes to our view, yeah, in terms of guidance. So five things, watch these, and those are the signals to watch to buy, yeah, and the timing is second quarter. So we're very explicit. We're not like many people in the market that we'd like to buy the dip. Yeah, but you know, what are you looking at? What are the things, key indicators, right? And essentially when and what. So we're fairly clear on that from that perspective.
Okay, that comes to my last question already just now. So, is there any last advice for our investor, Dr. Jha, before we come to the end of our money chat?
Yes. So the conclusion is, which we haven't talked about before, Nova. So I kept, I guess, the best for the last, as the cliche goes, is that right now, as we sit here on March 2022, hopefully we'll meet again in a couple months. We are not as headed for a black swan event. And the key reasons are, so first is we're not headed for a black swan event. The bears will be out there. Oil is coming to an end. Sell. This year. This whole year. Forget about equities. It's more of cash. As those headlines go up, more heuristic things that I look at to buy the dip, and I see the market becoming increasingly negative and increasingly priced for disaster. I'm like, I'm getting there. I like it because all my signals are coming to give clients the idea to buy that dip. Black swan event is not on the horizon. Look at what's happening in the money markets, in the major money markets, what's happening in the repo markets, what's happening in terms of credit markets, what's happening in terms of settlements of FX, fixed income, and equities. Don't see any kind of congestions or liquidity risks out there. Don't see it. Right? Doesn't mean it ain't going to happen, but I don't think it's going to happen at least in the next several months. That's a long conclusion.
Okay, thank you very much, Dr. Jha. Thank you for your time. There is certainly a lot to digest, and the market is constantly changing. Having said that, your sharing is very impactful for our investor. Take care and stay safe. So for our investor, Please scan below's QR code to know more about our fund discoveries for second quarter of year 2022 to get ideas for funds that can be potentially included in your investment portfolio. And please discuss with our relationship manager if you need more information. Thank you again, Dr. Jha.
Thank you. My pleasure.